right. So when we talk about the world of investments or the world of investing, we all know that fund managers follow different styles of investments in their portfolio. Also, depending on the theme of the portfolio, they get to decide what kind of investment style they should be opting for. But you, as an investor, how important it is for you to identify these kind of styles? We are talking about value-based investing. We're talking about growth-based investing. What kind of market momentum or market trajectory supports what kind of investment style? How can you as an investor incorporate these investment styles in your portfolio? Let's decode all of this. I have with me Piyush Chandra, Vice President Product, IFL Capital. Piyush, good evening and welcome to the show. So let's just understand. We are talking about value-based investing and growth-based investing. What does this mean?
So, growth investing and value investing are two very popular investment approaches. In growth-based investing, it focuses on companies with potential to grow their profits and revenues faster than their competitors and peers. Uh, a price of these companies are generally, correctly valued or overvalued due to high growth expectations. Growth stocks have high price to earning ratios. Now, at times they have higher price to book as well and higher EPSs. Growth stocks can have sharp price increase and volatility. The investors who are generally growth investors are typically willing to take more risk, for higher returns in their portfolio. Growth stocks can provide significant return during strong market periods, but may be very volatile. While when we come to value investing, it focuses on companies whose stock price are lower than the intrinsic or fair value because of certain conditions. Market is not correctly pricing these stocks for now. Uh, their price to book and price to earnings are generally less as compared to their peers, but their dividend yields are very high. They are less volatile, and value investing can be put across as a very slow and steadier approach of investment. Value investors generally look for a bargain in terms of stock price. Temporarily, for some reason, the stock or the sector is not popular. The company is being ignored by the market. They now value investors actually hope that the true value of the company will be recognized by the market, which will eventually lead to the price increase.
All right. Can you also help us understand what kind of market momentum we are talking about that supports what kind of investment styles?
Sure. So, different market conditions actually, have different impact on growth and value investing. Growth stock tend to perform well during economic expansion when investors are willing to pay premium for higher earning growth. Conversely, value stocks often outperform in the market downturn as they are perceived to be safer and due to their undervaluation. So, these are situations wherein the growth or the value stocks can actually outperform or underperform the market.
Now, when we talk about value investment, we talk about growth investing. Right now, the current market condition supports growth-based investments. And if you could also explain this by any kind of fund where the returns have shot up because of this kind of investment style.
See, what happens is typically, as I told you, during economic expansions, growth style of investment does very well. If you look at last 1.5 years, value has actually done fairly well because, because of the geopolitical risk or this uncertainty in the, economy, and then, uncertainty of the, government coming back. So value styles have actually done very well in last 1.5, 2 years. But if you're going forward, growth style of investments should do well because of the fact that India's growth story is still intact. There's an economic expansion that is happening within the economy. The government measures are there in order to push the economic activities in the country. So going forward, growth style of investment should lead the way. Obviously, if you look at historically in Indian markets, mid cap and small caps have actually outperformed the large caps. which actually is a good example that of the growth potential that the market has. Further, the Indian market's price to earning ratio is higher as compared to the other emerging markets, which also gives a strong indication and confidence for future growth. So there are various factors that growth oriented investment style should do well from here on. But historically, yes, as I told you last, couple of years, values investment styles have actually done very well. And there are few funds, which have actually done very, very well, when it comes to value investing. The first fund that comes to mind is ICICI Prudential Value Discovery Fund. It's, started, I think, around 2004. It has completed nearly 20 years. If you look at the CAGR performance of that fund is around 20% CAGR. So 20% CAGR performance in 20 years, I think it's one of the best performance that one can have in a portfolio or from a fund. So there are few funds, especially, again, coming back to the other value, the other investment philosophy, which is the growth oriented. So, there are funds in the market which are actually tilted towards growth investment style. UTI Flexi Cap, is one fund that actually comes into mind. UTI Flexi Cap, if I'm not mistaken, was started in 1992. So it has a 30 plus year track record. And I think it has a CAGR return of anywhere between 15.5 or 16%. So that ways, they know these funds have actually done very, very well. If a person is investing in a growth or a value investment style and is investing for a really long term, which is 20 years, 30 years, they tend to perform nearly the same. The kind of returns that you will get will be almost similar. But there are various economic cycles when sometimes growth oriented funds or growth oriented investment style actually outperforms value, and there are times when value oriented investment style outperforms growth.
Piyush, now most of the parameters and points you've covered in your answers, but what about the risk involved that we are looking at? Which investors, I mean, everyone, just wants to catch the momentum and want to make returns on their investments, which is fine. But one also needs to consider the risk that come attached with these kind of investment styles. So, what would that be?
So obviously, in your question, there's another investment style that is called momentum based investing, which is the very risky investment style. But when you compare growth versus value, obviously growth actually tends to be more riskier, because here the investor is not actually looking at the current stock price; they are actually looking at the higher chance of returns that they'll make from these companies in over a period of time. So obviously, growth investment style is a little riskier. While, as I told you earlier as well, value investment style is a very slow and steady approach, wherein I'm looking out for a bargain in terms of price in for that company or stock, and then over a period of time, we feel the investment manager feel that the value unlocking will happen in the company, and a fair price will be achieved by this company or stock.
All right, Piyush, typically what kind of market caps we are looking at when you talk about growth-based or growth style investing?
So obviously, growth style investing, when you look at, you're looking at, largely large cap kind of a companies. But no, if you actually look at growth or value in type of investment strategy, it is very company specific, or it is very sector specific. So you can find growth oriented companies even in mid cap or small cap, but largely you will find growth companies in large cap or or large mid cap kind of a names. But when we are talking about value kind of investment, value investments largely is found in mid cap or small cap. So there are good amount of companies wherein you will find good value for investments. There are companies, especially in small cap names, wherein the market is not fairly pricing their price as of now, and there are some assets or some kind of a economic moat that the company might have, which can actually lead to a price correction in a positive manner for these companies.
So when we're talking about investors and investors opting these kind of investment styles, how should they ensure that their portfolio is diversified enough? Because see, for retail investors who are doing their investments via an SIP, it is not necessary it was necessary for them to follow this particular investment style. But just in case they want to do it, understand a fund manager's investing style, and accordingly incorporate all of that in their portfolio. At what stage are we looking at when an investor should introduce these kind of investments in the portfolio? We obviously need to have a basic foundation of the portfolio covered before we opt for these kind of investment styles, or according to you, one doesn't need to bother about all these things, just pick up the kind of fund you're comfortable with, and that will be all.
So I would personally feel that it is more important for our investors to understand its risk profile, understand their financial goals, and understand the goals for which they are investing. It is more important for them. The various investment style can suit market conditions, and there are investment managers who will actually lead you to that way. So as they say, there are various ways to reach heaven. So investor wants to reach their ultimate goal of investing. So there are various ways. There is a value style, there's a growth style, there's a momentum style, or now most of the investment managers have actually come out with a mixed style which is called GARP, or growth at reasonable price. So most of the investment managers are actually following that, which is nothing but a mix of growth and value. So, investors should focus on more of its financial goals, more of its understanding the risk associated with the fund, and leave this investment style, I would say, largely to the investment managers, because they are experts. They understand the market much better than you and me, or probably a retail investor. So I would say that they should choose the right investment managers. And while choosing the investment managers, yes, they can actually look at which investment managers have actually performed know how well in various market conditions. Now, as I gave you an example of ICICI Approved Value Discovery, ICICI as a fund house was largely known as a value oriented fund house. But since now their product bouquet has actually become large, so they have incorporated some growth oriented funds as well. Earlier, Access or Mirai or UTI used to be known as a growth oriented fund house, but now again, they have also incorporated certain value oriented funds in their product bouquet as well. So for an investor, I feel that their risk and their goal, financial needs, is much more important as compared to choosing a investment style. That should be left to the investment manager.
Piyush, I think that will be all. Thank you so much for taking time out and explaining our viewers about different type of investment styles, especially value and growth. Thank you so much for being on the show today.
Thank you.